All right, we're going to get started today by looking at the S&P 500. All right, the most important line we're following right now is this 20-day exponential moving average. That is a an average that this S&P 500 has hugged for over a year or more. Um, as long as we're above that, we'll continue to go up in the S&P 500. So we're going to keep our eye on that. And let's see, we are overbought in by all imagination. We've been overbought for 2 months, and we're approaching one of, seasonality wise, one of the worst months of the year in the stock market. So if we look at our seasonality charts, you can see that June is basically a flat month on average, seasonality wise. And then we have August, September as poor months. Um, People say that this is because in the summertime, people are on vacation, there's not as much interest, and um, that's one theory. But you just have to keep that in the back of your mind. It doesn't work all the time. Otherwise, we'd all be trillionaires. But we have lower volatility in the summertime too, usually. Um, and then we have heightened volatility towards September, October timeframe. So keep that in mind. Okay, so if you look at our S&P trend line, you can see it's very well established, and we're basically at the top end of our trading range, and we're overbought. So this is and we're approaching one of the um, lackluster times of the year, seasonality wise. So it's not a good idea to put big bets on right now. Okay, so let's look at where we are in the calendar. We basically completed the majority of earnings season so far. We have one more big report. That's Micron. That's on the 24th of June. So we have to wait like a whole month for that. We do have triple witching, which is expirations, multiple expirations happening at the same time. So we have a very volatile day coming on the 19th of June. We have the first Fed meeting with the new Fed chair, 16th and 17th. So it doesn't look like we're going to be cutting rates this year, and that's not good for the stock market. We have a lot of inflation, we have a high price of oil, and it seems like the cards are towards either not doing anything or raising. So that's not good for the stock market. So on top of we having a summer doldrum time, we have a possibility of no raising interest, no cutting of interest rates. So that's not good for the stock market. And all right, let's look at what happened this past week. One of the most prominent reports of the week was Dell. Dell came out with earnings better than expected, with better AI revenue and projections. They went up 32%, which is pretty amazing. And that was the big news of the week. This coming week, we don't have a whole lot going on. Most of the earnings reports are over, the big ones. We have HPE, Hewlett Packard, and we have Broadcom. So, and that's basically the ones that we're following. We'll go over Broadcom a little bit later on today. It's one of it's considered one of the big tech stocks, not the Mag 7. It's very close in size, so it could be included in that group. Let's look at our numbers. The S&P has up 1.2% from last week. We have 56% of the S&P above the 50-day moving average and the 200-day moving average. So that's a good sign of momentum. And we are overbought though. And the short range S&P short range oscillator is overbought at 2.63. So our translation for that is, whenever it's overbought, you don't want to be putting in big positions because a lot of times the stock market sells off after there's an extended amount of buying. Okay, so the 10-year yield is down 2%. This is a huge move. And we're going to see what sectors go down and up whenever the 10-year yield goes down. That is very supportive of companies that need to borrow money. And it's very supportive of tech stocks also. Okay, so let's look at, okay, so we have an overbought condition at 93. Um, in general, it's not a good idea to put on really big positions whenever we're overbought, but overbought doesn't necessarily mean the stock market's going to go down. It just means that we have a lot of people buying. So it's always a good indicator to keep in mind when you're putting in new positions, but individual stocks have an oversold and overbought condition, so it might not apply to every stock. All right, so our translation for an overbought condition for the S&P short range oscillator suggests the market is overextended to the upside and is due for a pullback. So keep that in mind. Okay, so this week we have we've been going back and forth between um, the price of oil and inflation increasing and the price of oil and interest rates decreasing. So this week we had a lot of interest rates going down, price of oil going down. So let's go through this. Whenever we see a possible end of war, we see the price of oil decreasing. Inflation, therefore, decreases. Interest rates also decrease. The chances of rate cuts go up. Stock markets alike when a rate cuts happen, and recessions chances go down. So stock market is going to really like this interest rates going down and the price of oil going down. Perhaps next week we'll be looking at this side. We don't know. Okay, the 10-year, you can see that we went down a lot. That's 2% is a huge amount in a week. And there is an inverse correlation between interest rates and the S&P, and it was a perfect inverse correlation this week. All right, look at this. The price of oil is down 17%. That's probably because we're making a lot of progress on making a truce between Iran and the United States. Inflation is 3.8%. Um, the US dollar index is unchanged from last week, and the price of gold is unchanged also. Perhaps the price of gold, a stronger US dollar tends to drive gold prices lower. A flat or unchanged US dollar tends to keep gold unchanged. Maybe it was a perfect correlation this week. All right. So you can see we're in a trading range right now for this US dollar. So that's really good for companies because there's more predictable earnings for multinationals. Okay, fear greed index. We're greedy. So our translation is take some profits off the table or don't buy. So we're in a very dangerous time right now in the stock market where everything is going up. People are excited. Warren Buffett would say, be fearful when others are greedy, and greedy when others are fearful. Right now, he would be fearful when others are greedy. Okay, look at this. The amateur investor, the American Association of Individual Investors, the amateur investors are bearish. So that's a contrary to our other indicators. So when the amateur investors are bearish, it's time to start looking for something to buy. Okay, so the VIX, we are now down to 15. That is really low. That means we have no fear in the market. And that is a sign that we have a green light for stocks to go up. All right, so we have right now, greed is our primary emotion in the stock market. And there's absolutely no fear. So we're delusional and we think there's a new paradigm with this AI. And we're going right into the summertime. Perhaps we would get a denial and a fear and a capitulation sometime between now and September. We'll see. Okay, let's look at our first to worst. You can see that energy was the worst from last year. It's one of the better sectors this year. We have IT up 23%. It did good last year and it did good this year. That's primarily because the earnings are growing faster for IT than any other sector. So let's keep an eye on those. Let's look at our sector valuations. Energy and financials are the least valued in healthcare, are the least valued of all of the sectors. The most overvalued, industrials and consumer staples. A lot of times, whenever I look at this, I keep in the back of my mind, energy, financials, healthcare are on sale. If I see any bargains in there, it might be time to start nibbling. They're out of favor now. I say nibble because whenever a sector is out of favor, you don't want to put a lot of big bets on a stock or a position. Um, so I like the dollar cost average into positions. Let's look at the best performing sectors this year. We have the energy sector, number one, IT. Energy sector was the worst from last year. Now it is the best. IT is the next at 23%. The industrials, materials, and the S&P is up 10% this year. The worst performing is financials and healthcare. All right, this is a good thing to keep in mind. Right now we have 3.8% inflation. If you had $1 million in the year 1995 and you put it in your mattress, it would be worth a $500,000 right now in buying power. So that's why it's pretty important to keep in mind that inflation rate and how much you're losing in buying power every year that there's higher inflation. So the way to get around this is investing in things that are growing more than 3.8%. So you want to buy some, I mean, perhaps invest in stocks or um, REITs or some kind of investment vehicle that can help maintain your buying power over time. All right, let's look at some of the stocks going up and down. Okay, we see Dell was up 32%. Most likely, whenever you see a big move like this on a big stock, it's usually covering rally. So short covering is whenever people short a stock, and then whenever there's good news, they cover and they're forced to buy. And when you have outsized moves like that, that's a very good chance that's happening. It's probably happening also with ServiceNow. ServiceNow was down like 90% from its highs, and now it's going up 14% every day. Let's look at so the thing that is in common for the top market movers we have new technology, AI data center, and yep, that's it. AI is the theme for the stocks going up. A lot of times, whenever one stock like Dell goes up and they say that AI sales are better than expected, that basically floats all of the other boats in the AI world. So that's why we have a lot of these other companies that are AI related going up in sympathy. Let's look at the stocks going down the most. FedEx, they um, they spun off a part of their business, and a lot of times when companies spin off a company as a part of their business, it's usually not as profitable and so maybe that's why people aren't that interested in the spin-off. This is more of a part of their business. Let's look at some of the other ones going down. We have Intel, Autodesk, Rollins. I don't see how any of these are related. Okay, no comment on that. Let's look at the sectors going up and down. Well, first, before we do the sectors going up and down, we can see from our 10-year chart that the 10-year has been going down. So interest rates have been going down. Let's look at our cheat sheet. Yields of the 10-year going down. When the 10-year yield falls, it generally signals lower interest rates, which benefits sectors with high debt, high growth potential, and dividend paying appeal. Let's see if that is what happened in the market sectors. Okay, so we expect high yielding to go up the most. Is that true? We have technology up 2%. We have gold up 5%, no, 3%. We have banking, biotech. They're heavily indebted, so so having lower interest rates is going to help them. We have home construction. When interest rates go down, homes are more affordable, mortgages are more affordable, they sell more homes. That helps that sector. Semiconductors. There's just a winning streak in the semiconductors, and that is why they are not going down. The ones going down, and let's look at this. We have utilities, high yielding sectors going up. Let's look at the sectors going down the most. Retail, consumer staples, telecom. That's strange. I would think high yielding telecom sector would go up whenever yields go down. Energy. Okay, that was a good exercise. Let's look at our market mover. We already looked at that. Let's go back to our talking points. Okay, so let's look at Dan Now's update from LinkedIn. He said last week S&P 500 is up 1.4%. It's ninth straight week up, and as oil fell 10% to 87, with bond yields down across the board. Tech led with Mag 7 up 48%. Headline and core PCE coming in below expectations. So because this inflation read came in below expectations, that means that helped that interest rates go down. Given a sharper move lower in oil and a decline in bond yields, it will be important to see the progress with Iran. Over the near term, the overall market at some point will need to take a breather from increasingly overbought technical conditions. So Dan Niles thinks we're overbought and we could have like a 5% correction sometime soon. After 9 straight weeks of weekly gains, the S&P is now up 19% from its close on March 30th. but I feel like any losses will be contained to a 5% pullback, which is typically seen 3 to 4 times a year. As a result, I'm looking for beaten down stocks in the consumer discretionary sector that can benefit from oil prices and less turmoil in the Middle East. The S&P sector is just up 4% year to date, largely due to oil prices. Now, having said that, over the long term, I feel much the same as I did the end of last week. There are reasons to remain optimistic for the rest of the year. And whenever we had this same situation before, where we had a downturn and a rise up, those years finished up 31%, 27% respectively. Positives for the rest of 2026 include oil prices declining through the year end. S&P earnings expected to increase 25% this year. AI CapEx growing and 70% driven by the agentic AI, and the desire for incoming Fed chair to cut rates, which should offset pressure from the bond market. Okay, that is an awesome update from Dan Niles. He thinks we're going to have a little bit of pullback. He thinks that we're going to be good for the rest of the year. We have a lot of tailwinds, such as low price of oil and lower interest rates. So we'll see if that happens. Okay, risk on versus risk off. Past week, we've been risk on. We had IT going up, stocks that with high PE ratios, high PEG ratios, no dividends. Risk off didn't perform very well at all. So let's see what happens next time. All right, so let's look at our screening results. We see um, GE Veranova still in there it's like almost half priced. We have Wells Fargo it's like 10% off. We have Apple Oven, a software stock. The software stocks got killed recently. But look at what I do when I look for stocks. I, I, I choose I organize every one of these rows into the best performing and um, second best. So the best numbers for the return on equity are listed in green, and the second best are listed in yellow. Um, so I like to look across the board and see which ones have the most green. And you can see that GE Vernova has some of the best numbers for that. And I thought it'd be interesting to go over Marvell. Look at all that green there and the yellow. So we have a company, supposedly they're growing at 50% and their cash flow growth rate's 61%, revenue growth 22%. So we'll go over Marvell. They do chips and with the AI theme. And we also have Mercado Libre and Carvana as ones that have a lot of green, but we already researched those and they seem undervalued, but they're kind of smaller and we already looked at them. So let's look at Marvell. This is a stock that's a chip stock, and they're actually making some custom chips for the large hyperscalers. And you can see that it's almost every one of these chips stocks is going hyperbolic right now, and it's super overbought. So it's really hard to buy a stock like this whenever we had such a big run up. Let's look at the numbers on Marvell. They have a PEG ratio of 1.17. Whenever I did my calculation of PEG ratio, it's growing at 51%. Its PE ratio is 51, so it's basically fairly valued right now. So whenever I see a stock like that and it's in a parabolic mode like this, I like to wait for a pullback. I would like to buy it like right around here. So this is like 146. Let's see if we get a pullback. Then it would be on sale. I like to buy stocks that are on sale in general. Okay, let's look at what CFRA says about Marvell. No, this is Morningstar. They think it's 13% undervalued. They say their data center portfolio continues to gain momentum across custom, complete, and networking. We've been bullish on this opportunity, but now we expect to get even higher growth in medium term, led by a longer ramp of custom chip growth and higher optical investments. Okay, so CFRA has a favorable opinion on it, and they have a buy rating. But when I look at their fair value, they say they're overvalued by 23%. So immediately I'm like, I don't want to buy this when it's 23% overvalued. So I'm going to wait for it to go down in half. It'll probably will go down in half again. So um, you can see that they're not very consistent over time. We have negative, positive, negative, 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 positive. That's not a really good track record. I don't think Warren Buffett would buy this one because it doesn't have that good track record. So, okay, there's a good article here. The chip rally has gone parabolic. It's time to separate the pillars from the pretenders. And this is a pretty good article. Barron's wrote it. And indeed, the gains have been indiscriminate, while NVIDIA is up 30%. Lower margin chip makers like ON Semiconductor and ST Microelectronics have each risen 122%. So we have a dichotomy. Some of the stocks in AI are traded at a very high PE ratio, and some are not. Like the memory makers have a very low PE ratio. So this guy, Gavin Baker, he said the multiples can't be accurate. You have memory makers at a low to mid single digit PE, and you have NVIDIA at a low PE, and you have other accelerator companies at reasonable market multiples. And then most everything else, power, cooling, optical, and semi-cap equipment are dramatically higher multiples. So he thinks that there's a mismatch, and the memory makers and the chip companies like NVIDIA are undervalued. So even AI can't change the fundamental cyclical nature of semiconductors, but it can and will lengthen this cycle. So everyone's worried that there's going to be an overproduction of chips and eventually the prices will go down. But right now, he thinks that Micron, NVIDIA, AMD, Broadcom, and Taiwan Semi are undervalued relative to expected earnings growth in the next 2 years. He says all five stocks traded a PEG ratio, price to earnings growth ratio of less than 0.6 times. So we're going to look at each one of those stocks to see if they have any validity. We've been looking at Micron forever, so we're not going to go in a deep dive at Micron, but we're going to look at these other ones. Okay, you can see that from the chart on NVIDIA, it's still in a sideways pattern. It's been going sideways for over a year. And it looks like it's going to continue that cycle of this range. But you can see it's oversold right now. Whenever it reported its earnings, I remember the week before earnings, I said we're at the top end of the range. It usually buy on the rumor, sell on the news, and it ended up selling on the news. Now we're back down to the bottom end of this range. So, um, so it's oversold, and it's at the bottom end of its range, and it's quite undervalued. Let's look at the numbers to see what it's worth. NVIDIA right now is growing at 31% according to our numbers. It's from this year to next year at 31. 36% from 27 to 28. The PEG ratio, according to Yahoo Finance, is 0.65. Um, and the forward PE is 24. So if you divide 24 by 31% growth, you'll get a PEG ratio of 0.77. That means it's at least about 23% are undervalued. So Yahoo Finance thinks it's 35% undervalued. But we can see the numbers are just really good. The return on assets, um, return on equity is 114, which is really good. They have more cash than debt, 40 billion in cash, and they've been investing in a lot of startups and their customers. So they have a portfolio of stocks such as Intel that they invested in that have gone up 50% this year. Hmm. All right. So, and they have 46 billion in free cash flow, which is amazing. C4A still has a strong buy on it. They say our strong buy opinion reflects NVIDIA's transition to full stack AI infrastructure provider. We're positive on NVIDIA's growth trajectory, greater than greater cash return to shareholders, at least 100 billion annual rate on 200 billion free cash flow run rate. An evaluation about 18 times. They're confident that Vera Rubin's going to be 35x higher inference throughput versus Blackwell. So they got a new product line that's really good, accelerating diversification beyond hyperscalers, expanding AI adoption across enterprise and sovereign regions. Okay, so that's the thesis for CFRA. Fair value, you can see that CFRA thinks they're worth 365. That's quite a bit undervalued. They say it's 72% undervalued. So it's almost half priced according to CFRA. So you can see the earnings here. This is what you want to see in a good growth stock. Look at that. 119, 294, 490. It's going up very consistently. You can see that Morningstar thinks it's 20% undervalued. They said the massive AI adoption remains on track, fair value up 8%. All right. So another article that came out today, NVIDIA debuts RTX Spark processor for Windows laptops, taking aim at Intel and AMD. So this is another form of making money for the company. So let's look at another stock that was listed as an undervalued stock. Let's look at TSM. TSM is a company based out of Taiwan that manufactures chips for a lot of the big companies such as Apple. They make iPhone chips. They make chips for almost every major hyperscaler company and specifically NVIDIA. Let me see. So their profit margins and operating margins are really good. Return on assets and return on equity are 3 times what we're looking for. And the balance sheet, look at this. I've never seen a company with so much cash. They have 2 trillion in cash. That's almost as big as their market cap. Isn't that incredible? And their free cash flow is 719 billion. This is one of the most cash rich and highest free cash flow company um, that I know of. Okay, let's look at what Morningstar says about it. They think it's 5% undervalued. Okay, let's look at what CFRA says. They have a buy rating. They said our buy rating reflects TSMC's structural role as critical AI chip supplier, supplying, providing earnings visibility and pricing power. Demand for leading edge nodes and advanced packaging likely exceeds available capacity, keeping utilization high and reinforcing customer commitments. So this is a, didn't give a fair value. That's not so great. So my conviction for this stock just went down like 20%. Whenever I have a fair value from CFRA, that really gives me a sense of confidence in buying a stock because if my numbers of calculating a fair value match their numbers, that's a good sign that you're onto something. But you can see this is an excellent growth projectile for their earnings. Look at this 12, 13, 14, 19, 22, 38, 44, 65. So let's look at another stock that article had as undervalued, AMD. I looked at their numbers and they're growing at 57% from this year to next year and then 28% from the 27 to 28. So if they're growing at 50%, 57% this year, their PE is 73. So we immediately know it's overvalued. This is a very high PE ratio. So about 30% overvalued. Immediately, I'm like not that interested because I don't want to overpay for a stock. And Yahoo Finance agrees that it's around 25% overvalued. So let's look and see what CFRA said. They have a strong buy, and they said they're closing the gap with NVIDIA via a certain processor series launch in second half of 2026. So they're making some chips that compete with NVIDIA for AI. So that's why they're up. And their fair value, they're overvalued by 14%. So that matches our overvalued. We think it's overvalued by 25%. They think it's overvalued by 14%. So this is a no touch for me. I don't like buying things overvalued. And you can see that the numbers aren't that consistent over time. So Warren Buffett wouldn't buy this one either. Okay, so there's another stock that was in that list. Broadcom, AVGO. You can see that it's in a super uptrend, um, very consistent uptrend, and we're above all the moving averages. So, and we're overbought with AVGO. Let's look at their numbers. They're growing at 62%. The PE ratio is 40. So the PEG ratio is 0.6364. That means they're 36% undervalued. That doesn't match Yahoo Finance. So Yahoo Finance thinks they're fairly valued. That means Yahoo Finance thinks they're growing at 40%. So, hmm, all right. So all their numbers look good. Profit margin, that's three times what we're looking for. Operating margin, return on assets, that's bare bones bottom of what we're looking for. And return on equity is three times what we're looking for. They have a lot of debt though. Look at this. They have around 52 billion in debt. So that is, as interest rates go up, they're going to have to pay more to finance that debt. So they made a big acquisition, and that's what will cause their debt to go up. But you can see they make 25.5 billion free cash flow. So they can easily pay that off in a couple of years. Okay, let's look at what CFRA says. No, this is Morningstar. They said it's 11% undervalued. Let's look at what CFRA says. They said it's a buy and they have a fair value overvalued by 29%. Okay, immediately, I'm not interested in this one. I'd rather buy it when it's on sale or the fair value is higher than where it's at now. All right, so I thought it'd be interesting to to look at Micron. We've been looking at this every week, but whenever I have big positions in a stock, I like to review the numbers on a regular basis. You can see the forward PE is 9.8, which is really low. And they're scheduled to grow 443%, 27 and 28. So if you look at this year to next year earnings, they're basically fairly valued because a PE of 10 growing at 10, it's like fair valued. But look at this year, 443 and 27 to 28. But I looked at CFRA. They said the fair value is at 3,226. So it's undervalued by 232% according to CFRA. So this number keeps going up every week. Last week it was 3,000. Now it's 3,200. But you can see almost all the semiconductor stocks are in this parabolic going up, but we're at the top end of the range if you map it out this way, and we're overbought. Okay, so all right, that was my talk for today. I hope you enjoyed it and have a good investing week. I'll see you next time.